Welcome to the monthly MOTR checkup. This is Dave Lundgren, Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The name of the video for this month is Ruh Roh Raggy, which hopefully will make sense as we get through the slides here. But before we do that, let's take a quick look at the disclosures for the month. So, Ruh Roh Raggy. So this is Scooby Doo's phrase that it was an expression of his of alarm or concern, and he often said it in moments of impending danger or when Scooby realizes something has gone wrong. The recent deterioration in our risk gauge, which we've been highlighting in recent notes, is a Ruh Roh moment for us. So for 2 years, the mega cap S&P has diverged with the average stock. This is something we've been writing about, as have others, about for quite some time now. But we felt that it was just a matter of time before we discovered which of those two barometers of economic activity was right, because we didn't feel it was sustainable. So ultimately, the risk gauge had been good and getting better, which was good enough for us to ignore virtually all the things that were kind of piling up in that in terms of bricks in the wall of worry. And I've written a couple of notes about those things that even I was worried about, even though I was still bullish. But the fact that the risk gauge was good and getting better was enough for us to give the bulls the benefit of the doubt. And we planned to do that until the risk gauge continued to get better. And unfortunately, as I said, it at the close of this month, it fell out of risk on in the important monthly time frame. So very importantly, this is not bearish. At least it's not bearish yet. So what that means is that oversold conditions still represent buy opportunities. What's changed is that the next overbought condition would be something that we may want to respond to in terms of raising cash or getting short. But currently, the market is very oversold. We saw a pretty decent response to today's oversold condition, and we envision that will carry through into the latter part of next week. At which point we'll have to make a decision if we want to be sellers into that strength. And barring any material improvement, that's going to be our plan. So the biggest takeaway is that the deterioration in the risk gauge, what that means is that the context for any strength has changed. So we no longer just want to ignore overbought conditions, which is what we want to do when we're in risk on. Risk on means we're in a bull market. When we're in a bull market, we want to ignore not only ignore overbought conditions in terms of selling them or even certainly going short into them, neither of which we want to do during a bull market, but we even want to, in a strong bull market, overbought conditions we want to buy. A good example of that would be a breakout. But with this deterioration in the risk gauge, we've now lost that the ability to ignore overbought conditions. And so now we need to respond to them and actually take profits into strength and potentially initiate new short positions. So I'm going to walk you through where the risk gauge is today, but I really highly recommend that clients go back and rewatch the November 24th the November 24 monthly MOTR checkup video, which was titled When Turkeys Fly. And in that video, I walk you through how the risk gauge behaved leading up to, during, and after the global financial crisis, and how well the gauge did, giving us ample warning of something quite negative about to unfold, staying bearish all the way through it, and then turning bullish relatively quickly after the lows. So just to get a sense for how the risk gauge might behave going forward in the months ahead, I would take the time to just quickly go back and rewatch that video as well. That's available on the website to subscribers. So going forward, the saving grace to all of this may be that global equities, ex-US, may finally be ready to take the lead. It's a big if at this point, and we certainly don't envision something where we see the US collapsing and the rest of the world going up. So in order for there to be a bull market outside the US, we do suspect that that it would have to be in keeping with just a sideways market at worst in the US. But if there is a silver lining in this cloud, it would be that perhaps the leadership transitions to the overseas markets that haven't really been participating for a while. So before I walk you through the actual readings on the risk gauge today, what I want to do is just give you a quick refresher on the gauge, just to remind you what the gauge is trying to accomplish for us, how to read it, and how to respond to the various readings. So when the gauges in particular in the medium term and the long term, when these two time frames are in risk on, that's by definition and out the way we define it, at least systematically, a bull market. And in that scenario, we want to favor long-term trend following, and we want to be buying oversold and ignoring overbought. And if anything, we might even want to be buying overbought, which again is buying breakouts and things like that. And that's the kind of behavior we want to maintain in a bull market. Now, obviously, the opposite is true in a risk-off environment. And the last time we had this was in 2022. And of course, we had it in the global financial crisis and post the 1999 bubble as well. And this was a clear risk-off environment. And this is how we systematically define a bear market. And in this scenario, we are favoring tactical swing trading, which is different from long-term trend following. Long-term trend following is something you do on the long side. You don't necessarily have targets. You just hold on to the holdings until they get stopped out with no upside targets. You don't sell into strength or anything like that. And I'm speaking, generally speaking here, that's how you want to behave. But when you're in a bear market, there is no such thing as long-term trend following, nor by definition is there anything such as long-term trend following on the downside because you can only go to zero, right? So by definition, in bear markets, everything is tactical. And you largely want to have minimal long exposure. And most of what you want to be doing is either be in cash, or if you can be more tactical and you're willing to go short, then you want to short overbought conditions and cover those short positions into oversold momentum conditions. So those are the two extreme sort of trending environments. And then what we get in the middle is what we refer to as mixed, or as I referred to it recently in a note, table pounding neutral. And in this environment, still tactical, so you're still not trend following, but in this environment where it's mixed, and I really want to highlight that, you want to both buy oversold conditions and sell or short overbought conditions. So in both cases, you're being very tactical. You're buying for a trade higher, and in the case of shorting it, you're shorting it for a trade lower, but not a meaningfully significant decline at this stage of the game because we're still mixed. So this is how to think about the risk gauge and how it can guide us through these transitions from bull market to neutral range bound environments, which can turn into topping periods like it did in the global financial crisis, and then onto a bear market. So with all that being said, this is where the risk gauge is as of the end of this month. Thanks so much for watching this clip of the monthly motor checkup video. We appreciate your interest in our research, and we hope that you are finding it helpful and informative. If you'd like to continue watching this video, as well as access our most recent monthly motor checkup, sign up for a free 30-day trial to all of our research at motorcmr.com. You'll find a link to our website in the description below. As always, like and subscribe to be notified of future content.